The gold signal the world can't ignore. Something unusual has been happening beneath the surface of the global financial system, and most Americans haven't been told how serious it is yet. Over the past 2 years, China has been quietly but aggressively buying gold at a pace that has alarmed central banks, commodity traders, and global investors. According to data from the World Gold Council, the People's Bank of China officially added more than 225 metric tons of gold between late 2022 and 2024, one of the fastest accumulation streaks in modern history. And that's just what's been reported. Analysts at Bloomberg and the Financial Times consistently warn that China's true purchases are likely much higher, routed through state banks and off-balance sheet channels to avoid market disruption. This matters because gold is not just another commodity. It is the backbone of financial trust during periods of instability. When a country the size of China accelerates gold buying while simultaneously reducing exposure to U.S. treasuries, China's treasury holdings have fallen from $1.3 trillion in 2013 to under $800 billion. It sends a clear message. Beijing is preparing for a world where the U.S. dollar is less dominant, global trade is more fragmented, and financial shocks are more frequent. At the same time, China has increased direct state involvement in metals trading. State-owned banks now play a central role in gold imports, pricing, and domestic distribution. The Shanghai Gold Exchange has expanded influence, and China has openly promoted yuan-denominated gold contracts as an alternative to Western pricing benchmarks like COMEX and the London bullion market. This isn't accidental, it's strategic. By controlling both demand and pricing infrastructure, China gains leverage over how gold is valued globally. Silver is following a similar path, but with even tighter controls. China is the world's largest producer and one of the largest consumers of silver, essential for electronics, solar panels, and military technology. In 2023 and 2024, China implemented stricter export oversight on several strategic metals, and while silver hasn't been formally banned, shipments have slowed. Reuters and CNBC have reported persistent shortages in physical silver markets, even as paper prices remain volatile, an imbalance that typically signals intervention behind the scenes. For the average American family, this isn't abstract geopolitics. When global powers start hoarding hard assets, it usually means they expect turbulence ahead. Gold doesn't surge in isolation. It moves when confidence in currencies, governments, and growth begins to crack. And right now, China's actions suggest it sees far more instability coming than officials in Washington are willing to admit. This is only the first piece of the puzzle. Because gold and silver aren't just being accumulated, they may be deliberately constrained. And that raises a much bigger question about who really controls pricing in the global metals markets. Is China quietly controlling the price of gold and silver? Here's where concern turns into suspicion. Analysts aren't just watching what China is buying, they're watching what China may be withholding. In gold and silver markets, price is supposed to reflect supply and demand. But over the last several years, that relationship has looked increasingly distorted, and China sits at the center of that distortion. Start with gold. China is the world's largest gold producer, mining roughly 370 metric tons per year, according to the U.S. Geological Survey. Yet almost none of that gold leaves the country. Exports are tightly restricted, and most domestic production is absorbed internally by state banks or reserves. At the same time, China continues importing gold through Hong Kong and other channels. This creates a one-way flow. Gold goes in, but almost never comes out. Economists at Reuters and the Financial Times have pointed out that this effectively removes hundreds of tons of gold from the global market annually, tightening supply without ever announcing formal controls. Silver shows even more strain. Global silver demand hit a record 1.24 billion ounces in 2023, driven by solar energy, electric vehicles, and defense technology, according to the Silver Institute. Supply, however, has lagged. The market has now experienced multiple consecutive annual deficits, meaning more silver is being consumed than produced. China, which controls a significant share of refined silver supply, has quietly increased domestic stockpiling while exports have failed to keep pace with global demand. The result? Physical silver shortages, rising premiums, and growing distrust of paper pricing systems like futures contracts. This is why many investors believe pricing mechanisms are being influenced rather than discovered. Futures markets in New York and London still set headline prices, but those prices are increasingly disconnected from physical availability. When paper contracts trade massive volumes of silver that doesn't physically exist, while real metal becomes harder to source, someone benefits, and countries with the ability to control physical supply gain the upper hand. Why would China do this? Protection. China's economy is under real pressure. Property markets remain weak, youth unemployment is elevated, foreign investment has slowed, and growth has consistently undershot official targets. In that environment, strengthening hard asset reserves acts as an insurance policy. Gold and silver provide stability if currencies weaken, sanctions expand, or global trade fractures further. There's also a strategic angle. Weakening confidence in dollar-based pricing systems weakens U.S. financial influence. The U.S. dollar still underpins global trade, debt, and commodities, but that dominance depends on trust. By encouraging alternatives, whether yuan-denominated contracts or bilateral trade settled outside the dollar system, China slowly chips away at that foundation. For American investors and households, this matters because manipulated or distorted markets don't unwind gently. When physical shortages finally overwhelm paper pricing, adjustments tend to be sudden and violent. Gold and silver don't rise gradually in those moments. They gap higher. And when that happens, it's usually because something else is breaking at the same time. Next, we need to connect this to geopolitics, because rising tensions between China and the United States are pouring gasoline on this fire, pushing global investors towards safe haven assets faster than most people realize. Geopolitical tension is fueling the rush into gold and silver. Every time tensions rise between the world's two largest economies, money moves first and explanations come later. Over the past several years, the relationship between the United States and China has shifted from competitive to openly confrontational. Trade restrictions, technology bans, military posturing in the Asia-Pacific, and financial decoupling have all intensified. Markets are reacting accordingly, and gold and silver are absorbing that anxiety. Since 2022, global central banks have been buying gold at the fastest pace on record. The World Gold Council reports net purchases exceeding 1,000 metric tons per year, levels not seen since the collapse of the Bretton Woods system. China, Russia, and several Middle Eastern countries have led the charge, but Western investors have followed. When institutions across geopolitical lines all move toward the same asset, it signals a shared concern. The existing financial order feels fragile. U.S.-China tensions amplify this dynamic. Each new tariff threat, export control, or sanctions announcement increases the probability of trade disruption or financial retaliation. Investors understand that conflict today doesn't start with tanks. It starts with payment systems, currency access, and capital controls. Gold and silver sit outside that system. They don't rely on trust between governments, and they can't be frozen with the push of a button. This fear shows up clearly in market behavior. During periods of heightened tension in 2023 and 2024, gold repeatedly surged even when interest rates were high, something that historically shouldn't happen. Under normal conditions, higher interest rates make gold less attractive. But when geopolitical risk dominates, safety overrides yield. Gold prices pushing above $2,300 per ounce despite restrictive monetary policy was a major warning sign that fear, not fundamentals, was driving demand. Silver, often called gold on steroids, reacted even more violently. Because silver markets are smaller and thinner, inflows create exaggerated price moves. Industrial demand combined with safe haven buying has turned silver into a pressure cooker. Analysts at CNBC and Bloomberg have noted that silver's volatility is no longer tied just to manufacturing cycles. It's increasingly tied to geopolitical headlines. For American families, this matters in subtle but important ways. Rising precious metals prices are often an early indicator of broader financial stress. They tend to precede higher borrowing costs, tighter credit conditions, and weakening confidence in paper assets like stocks and bonds. When gold and silver rise together, it's rarely a sign of optimism. It's a hedge against something going wrong. And while investors are watching metals, energy markets are flashing their own warning signs. because the same geopolitical tensions reshaping gold and silver are also reshaping oil, and the consequences there hit U.S. households directly at the gas pump and in utility bills. Oil markets are becoming the next pressure point. While gold and silver reflect fear about the financial system, oil reflects fear about the real economy. And right now, oil markets are being pulled in opposite directions by China, the United States, and a slowing global economy, creating instability that directly affects American households. China is the world's largest oil importer, consuming roughly 16 million barrels per day, according to the International Energy Agency. When China's economy slows, oil prices typically fall, but that relationship has broken down. Even as China's official growth numbers weaken, industrial profits down, exports under pressure, property investment still contracting, oil prices have remained volatile rather than stable. That's because geopolitics, not demand alone, is now driving energy markets. U.S.-China trade tensions are a major contributor. Tariffs, export controls, and the ongoing push to decouple supply chains have reduced long-term visibility for global growth. Oil traders are forced to price in contradictory risks, weaker demand on one hand and potential supply disruptions on the other. Any escalation involving Taiwan, the South China Sea, or sanctions-related retaliation would immediately threaten shipping routes and energy flows. Even rumors of disruption can move oil prices sharply. China's behavior adds another layer of uncertainty. In recent years, Beijing has aggressively expanded its strategic petroleum reserves, taking advantage of price dips to stockpile crude. At the same time, Chinese state refiners adjust import volumes in ways that exaggerate price swings. When China suddenly reduces imports, prices drop. When it re-enters the market, prices spike. This stop-and-go pattern makes oil markets more fragile and harder to predict. For U.S. consumers, this volatility translates directly into higher costs. Gasoline prices don't need oil to surge to $120 a barrel to hurt families. Even sustained prices in the $85–$95 range raise transportation costs, food prices, and utility bills. The U.S. Energy Information Administration has consistently shown that energy price spikes ripple through the economy within months, showing up in higher inflation readings and reduced discretionary spending. Energy security is also at stake. While the United States produces more oil than any country in history, it remains exposed to global price swings because oil is traded globally. When geopolitical tensions drive volatility, American consumers feel it regardless of domestic production levels. And if China continues to influence demand patterns while geopolitical risk stays elevated, oil markets are likely to remain unstable. This matters because energy volatility feeds directly into inflation expectations. And inflation is where financial stress becomes personal. Higher fuel costs don't just raise prices, they erode confidence, strain budgets, and make every other economic problem feel worse. Next, we need to connect the dots. Because what's happening in gold, silver, and oil isn't isolated. It points toward broader risks for inflation, financial stability, and U.S. economic confidence. What this means for inflation, stability, and American households. When gold, silver, and oil all flash warning signs at the same time, it's rarely a coincidence. It's a signal that inflation risks and financial stress are building beneath the surface, even if headline numbers temporarily suggest otherwise. For American households, this is where global market manipulation and geopolitical tension turn into real-life consequences. Start with inflation. Energy prices feed into almost everything. According to the Bureau of Labor Statistics, energy-related components influence transportation, food production, manufacturing, and housing costs. Historically, a 10% increase in oil prices can add 0.3 to 0.5 percentage points to headline inflation within a year. When oil remains volatile instead of stabilizing, businesses struggle to plan, and costs get passed down to consumers. That's how inflation becomes sticky, even when demand weakens. Precious metals tell a similar story. Gold is often called an inflation hedge, but in reality, it's more accurately a hedge against policy failure. When gold rises while interest rates are high, it suggests investors don't trust central banks to control inflation without breaking something else. The Federal Reserve's own data from Fred shows that financial conditions have tightened, yet gold demand continues to grow. That disconnect points to fear of future easing, renewed. Stimulus or currency debasement if growth falters. Silver adds an industrial layer to the risk. Silver is essential for electronics, medical devices, defense systems, and especially solar panels. The global push toward renewable energy has increased silver intensity per unit of output, just as supply deficits widen. If silver prices surge or physical shortages worsen, manufacturers face higher costs or production delays. That risk feeds directly into supply chains that U.S. companies depend on, especially in technology and energy infrastructure. Financial stability is another concern. Rising metals prices often coincide with declining confidence in equities and bonds. If investors begin reallocating aggressively into hard assets, it can drain liquidity from risk markets. That's how volatility spreads. Retirement accounts, pensions, and household investment portfolios become more exposed to sudden swings, even if individuals never buy an ounce of gold or silver themselves. For the average American family, the warning signs aren't abstract charts. They're budget pressure, job uncertainty, and higher costs with fewer options to absorb them. When energy, materials, and financing all become less predictable, households tend to pull back. That slows growth further, creating a feedback loop policymakers struggle to control. Which brings us to the final question: where does this go next? Because the actions China is taking today suggest this period of uncertainty isn't temporary, it's structural. Why this uncertainty is likely to get worse, not better. The most important thing to understand is that none of these pressures appear temporary. China's actions in gold, silver, and energy markets are not short-term trades. They are long-term strategic positioning, and that means the uncertainty facing global markets and American households is likely to intensify rather than fade. On precious metals, the direction is clear. Central bank gold buying is not slowing, and China has given no indication it plans to reverse course. Analysts at Bloomberg and the World Gold Council expect official sector demand to remain elevated as long as geopolitical fragmentation continues. If physical gold and silver supplies stay tight while paper markets remain heavily leveraged, the risk of sudden price dislocations increases. These aren't gradual moves. Historically, when physical shortages force repricing, markets adjust quickly and aggressively. For silver in particular, the outlook is fragile. Industrial demand tied to electrification, defense, and renewable energy continues to grow, while supply deficits persist. If China maintains tighter control over exports or increases domestic stockpiling, Western manufacturers could face higher costs or outright shortages. That risk feeds directly into U.S. industrial competitiveness at a time when reshoring and supply chain resilience are already under strain. Oil remains the wild card. Slowing global growth should ease prices, but geopolitical risk is overriding traditional fundamentals. Any escalation between the U.S. and China, whether through trade restrictions, sanctions, or regional conflict, would immediately impact energy markets. Even without a major shock, China's influence over demand patterns and strategic reserves makes oil prices more volatile than in past cycles. Volatility, not just high prices, is what damages consumer confidence and business planning. For the United States, the broader implication is erosion of financial certainty. When markets lose confidence in pricing transparency, currency dominance, and supply reliability, capital becomes more defensive. That environment is hostile to long-term investment and economic stability. It pressures policymakers to respond, often with measures that risk reigniting inflation or destabilizing debt markets. For the average American family, this means continued pressure on living costs, uncertainty around job growth, and increased vulnerability to market shocks. Even if the economy avoids a sharp downturn, the margin for error is shrinking. Hard assets rising alongside energy volatility are not signs of strength. They are symptoms of stress. The takeaway is simple but uncomfortable. China is preparing for a more fractured global economy, and its actions are already reshaping markets in ways that increase risk for everyone else. Gold, silver, and oil are sending the same message from different angles. The question now isn't whether volatility will continue, but how severe the next adjustment will be when confidence finally breaks.